Right now, the average savings account in America pays 0.62% interest. Some of the biggest banks pay even less than that. Meanwhile, the best high-yield savings accounts are paying around 4%. That's not a small gap. On the same amount of money, that's roughly 6 to 7 times more interest for doing nothing except picking a different bank. Let's fix that in the next 4 minutes. First, what is a high-yield savings account really? It's the same basic product as the savings account you probably already have, FDIC insured up to $250,000. Your money is fully liquid, you can withdraw anytime. The only real difference is the interest rate, and usually who's offering it. High-yield accounts are almost always online banks. No branches, lower overhead, and they pass those savings on to you as a better rate instead of spending it on buildings and tellers. Let's make the gap real with actual numbers. Say you keep $10,000 in savings, a reasonable emergency fund for a lot of people. At the national average of 0.62%, that grows to about $62 a year in interest. At 4%, that same $10,000 earns around $400 a year. That's over $300 a year in free money, sitting there, doing nothing extra, just for using a different account. Leave that money for 5 years and the gap widens even further because the higher rate is compounding on a bigger balance every year. So why doesn't everyone just switch? Mostly inertia. People open a savings account at whatever bank they already use for checking because it's convenient and then never think about it again. The account itself doesn't feel broken. The money's still there, still growing a little. It just isn't growing anywhere close to what it could be. A few things to know before you move your money. First, online high-yield accounts are still FDIC insured exactly like your current bank. As long as the institution is FDIC member, same protection, better rate. Second, rates on these accounts are variable, not locked in. They move with the broader interest rate environment, so the exact number will shift over time. But the gap between high yield and traditional savings tends to stay wide regardless. Third, some of these accounts have no minimum balance and no monthly fees at all. So there's rarely a real downside to switching your emergency fund and other cash savings over. One important distinction. This is for cash you want safe and accessible. Your emergency fund. A house down payment you're saving for. Short-term goals. This is not where long-term investing money like retirement contributions belongs, because stock market index funds have historically outperformed even the best savings rate over long time periods. Savings accounts are for protecting cash. Investing accounts are for growing wealth. Different tools, different jobs. Quick disclaimer, I'm not a financial advisor, and this video is for educational purposes only. Interest rates change regularly, and the specific numbers shown are illustrative examples, not a guarantee of future returns. Compare current rates before choosing an account. If this just found you a few hundred free dollars a year, subscribe to Control Your Wealth for a new personal finance breakdown every week. And comment, what rate is your current savings account actually paying you?